let me just go here and I just want to go make sure I hear myself. So make sure you all can hear me. Get started. Because that's usually. Okay, yes. Okay, now. So, all right, welcome to the March monthly training. We have Arlene Price here, a senior loan officer who is going to help us and educate us today on home loans. I have a lot of the questions that you all asked. I did present them to her before, but she's just going to give a good presentation. If you don't know, our theme for 2021 is home ownership. We want to help you become educated about this process and learn as much as possible so that you can be an educated buyer to help you stay in the home. For those of you who don't know, who haven't seen me before, I am Nia, the founder of Perspectives and this group, the Gold Digging Community. And this group is really based to help individuals just conquer everything financial. We talk about retirement savings, investing, saving, budgeting, debt repayment. Hopefully you're in our debt challenge. We're doing a 60-day debt elimination challenge right now. And basically we're taking the months of March and April and we're attacking debt. So I do like a training every Monday and I talk about different things to help give them tips and things like that about and then try to help them motivate to start the fire to help them get rid of debt. So that's what we're working on right now. And they get like an email every Monday, things like that. So I'll let Arlene go ahead and introduce herself and I'll give her the floor and I'll step back. All right.
All righty. Well, thank you, Nia. And I love that challenging Monday. I think that's phenomenal. I would love to get that information and share it with some of my clients and potential buyers as well. Because eliminating debt makes you feel so good.
It does. It does.
Really, you say, oh, wow, I've accomplished something. And not only does it make you feel good, but you can imagine what it does for your credit score. Talking about increasing the scores on your credit and helping you with your debt to income ratio, which is some of the things we're going to kind of chat about today. So as I was explaining to Nia, how I would like to talk to people when I have clients that come in and they said, I want to get approved for a mortgage. What are the things that, what are the few things that you looked at, or what's the process? And so basically the process is the first three things we're going to look at. It's your income, your assets, and your credit. Those are the three most important things we're going to look at. First of all, when we're looking at your credit, we're looking at your credit score. We're looking at your payment history. If you paid your bills on time in the last 12 months, we're looking at if you've been late, if you have collection items, if you've been in the bankruptcy. We'll take a look at all of that and then we'll sit down and we'll discuss that. If you got a 580 credit score, you can buy with the 580 credit score. However, we would like for your credit score to be higher. The higher the credit score, the better the interest rate, the better the programs, the better the loan options. You have more options when you have a higher credit score. Now, we can get you into a home with the 580 credit score, but with the 580 credit score, you probably just need to pay off some debts. I've got a client actually yesterday, and believe it or not, he had a credit card from Capital One that the max amount that he could actually, the max amount of credit they gave him was $300. And he had actually charged up to $300. I had him to pay $290 down on there. Believe me or not, that credit score increased by 50 points.
Wow.
It was 50 points. Unbelievable. And so that's one of the things that I like about, the company that I'm with and what I'm doing. And I didn't give you kind of some brief synopsis on who I'm with and what I do. Arlene Price, over 23 years in originating loans and helping people get into homes and helping them, guiding them or educating them on the whole process of getting into homes, helping them with their credit, showing them the best way to get their credit cleaned up. And when I say credit cleaned up, I don't do credit cleaning, but I know exactly what the lenders are looking for, what needs to happen to get their credit to where it needs to be. And so these were one of the things that I had, as I was saying earlier, that I had guided my guy into, getting some of those things paid down. We have what we called a rescore. with the company I'm with, we can rescore your credit. And basically what it is I take a look at your credit, I put it into a simulator, and it will tell me if the client pays this off, pays this down, or eliminated this, their credit score can increase about X amount of points. So I do that, and then I go back to the client and says, okay, you need to save some more money up and eliminate this debt, pay X amount of dollars towards this debt. Don't close out any accounts right now, because if you close out some accounts, it's going to affect your credit score in a negative way. So those are the things that you get when you come to me and we have a conversation. And everybody's different. Everybody has their own different, unique situation. Some people might be in a bankruptcy. If you're in a Chapter 13, I can help you buy a home if you're in a Chapter 13 as well. You will have to get permission from the trustee. And also, I will need to verify that you've been paying the bankruptcy payments on time for 12 months. But it doesn't say that you can't buy. If you recently discharged from a bankruptcy, as long as you've been out of the bankruptcy for 2 years and you paid your bills on time for the last 12 months, you can buy also immediately after the bankruptcy. And most of these loans are FHA loans, which is backed up by the government. I pretty much do, most of my loans are done FHA. And the reason being is because FHA is a lot more lenient, and it allows people to have had, had some credit blemishes in the past to not necessarily hold them back from buying a home. As long as we have a strong letter of explanation and we verify that you paid your bills on time in 12 months, you've demonstrated that you've taken the responsibility, you know what happened, you explain what happened in the past, and you've been able to explain to us, to show us how is it that you'll be able to eliminate from this happening again. So that's why I like FHA. FHA allows you to have a grant program, and they also allows you to have gifts where a close family member can actually give you the gift for the down payment and closing costs. And FHA allows you to have a lot higher debt ratio as well. And what I mean by debt ratio is the debt to income. And I just actually got a loan approved yesterday, and when I had, it was a 57.5 debt ratio. And in the normal required debt ratio, it's about 45 to 46. And like I said, debt ratio is all of your bills, all of your monthly debts, all your consumer debt that's on your credit report. We take that and we divide that by your monthly income. And that's what how we calculate your debt ratio. So your credit is one thing. Like I said, the higher the credit score, the better the interest rate. Credit score is 680, 690 or whatever, you can get a 2.7 interest rate, 2.8 interest rate right now. If you got a 580 credit score, you might have to get a 3.5% interest rate. You can buy, but your interest rate will be affected because we have what we call overlays. So overlays are a hit to the rate, because it's a riskier loan. So the lender is going to charge you a little bit more because the loan is so much more riskier. So after credit, then we're going to look at your income. We want to make certain that you're able to pay for the home, that you have a stable job. And if you had a job, we're looking at what you've been doing in the last 2 years. Have you been working in the last 2 years? And we all know that with COVID, a lot of people were laid off. They were off for a period of time. That's okay, as long as we have a letter of explanation and we can explain what happened during that gap period. But we want to know what you were doing before, and if you're working now, and how long have you been working? How long have you been in this job? One of the things that I've seen a little bit of in the last 12 months or so is that some people have been kind of job hopping, like 3 and 4 different jobs. We ask you not to do that, but in some cases you may not have been able to help yourself from not being able to do it. Some situation may have arisen and you had to leave that job, or you got a better offer. Then that's okay as well. But we will have to be able to paper trail all of those jobs. And when we look at your tax returns and W-2s, they all have to add up that you've been working for 2 years. So we're looking at a minimum 2 years employment. And we're going to take your gross income. That's what we use to calculate. We use that to help calculate your debt ratio, your gross income. So one, employment for 2 years. Here's another case. Just got someone who's buying a home now, has just started working in January. Last year, they were not working because they were in college. So I can use your college degree, your certificate, and your transcript to show the underwriter this person was in school for that full year. So now we can use your offer letter and as well as your current pay stub for 30 days to get you qualified to buy a home as well. So you're still eligible because you were in school, and you were in school getting educated on the field that you're working now. So that's another way, and that's an FHA financing loan as well. So we have that. The other one, we said credit, income, and your assets. We want to make certain that you can pay the mortgage payment. That
Okay.
you we want to make certain that you have money for down payment. And even if you're using the grant program, you still want to have some money in the bank. You want to have a cushion. They want to know that you can pay the next month mortgage payment. Then you have to have at least 3% of the purchase price for closing costs. So here's how that works. If you're buying a home for $200,000, the down payment of that is 3.5%. The closing cost for that is roughly 3%. So you want to have that much money in the bank. Now, if you're utilizing a down payment program, then you only have to have the 3% in the bank because the bank is giving you the gift, which is the 3.5% for the down payment. So you at least want to have that. You want to have enough money to pay for your appraisal, which is roughly $500, $550. You want to have enough money to pay for your home inspection, which is another $300 to $400. And then you got to have earnest money to be off the market, which is roughly $1,000 to $2,000. Just depends on the seller themselves. So the three most important things to get started with me would be your income, your assets, and your credit. And then from there, we can talk about getting you into homes, getting your budgets together, set up, getting you prepared to buy some investment properties, looking for some fix and flips or whatever. But we want to look at your income, your assets, and your credit. Now, I know you have some other questions that you had for me. You want to kind of go over those those questions that you had earlier?
I do. So first, I do want to say, when she said that if you're going through bankruptcy and you would have to get approval from the trustee, basically the trustee is the person. Like normally when you are filing for bankruptcy, you have to go to the court, the bankruptcy court, and attend a hearing. That court officer that you deal with is the bankruptcy trustee, and that's the person who you would need to give you that approval. Just for, in case someone who doesn't know.
Okay, that's great.
So, first question is refinancing a home loan from 2.9 to 225. Like, does that make good sense since, basically since those interest rates are so close together? If you have a 30-year loan, can't talk today.
No, to answer your question, no, that does not make sense. We have, it has to be a value. At least now I'm the same way now. You have to at least be saving by 1 point.
Okay.
And so to just
makes sense. Okay.
Yeah, it will cost more to try to refinance that than it will be for your savings, because you still got to pay title fees, you got to pay closing costs, you got to put money in escrows and all of that. So no, that wouldn't make sense at all. I wouldn't even advise anyone. I wouldn't even touch a loan like that. My theory is if I'm not saving you at least a point, then it doesn't make sense.
Okay. I mean, and you appreciate loan officers like that because, that just to me says that you're not just in it to make a buck. You're in it, you actually care about the interests of the actual borrower. Next question is, so you spoke about closing costs. Can you discuss like a lot of the different fees that might come with the closing costs?
Yeah, so the closing costs consist of fees, underwriting fees, origination fees. Some loan officers charge origination fees. I don't charge origination fees, but most loan officers or lenders do. Title fees, credit report fees, processing fees, escrows. And what I mean by escrow is that when you pay property taxes and insurance, we have to set up a separate account, with the lender to escrow about anywhere from 3 to 5 months of property taxes and homeowners insurance. And that's so that you're not responsible for paying it on your own. The mortgage company will pay for that. And so, yeah, those are some of those fees are in there, transfer, title, recording fees to record your name and information on the deed. Fees of those, that's anywhere from $60 to $100. And so all your fees, for the most part, come up to around about 2.5% to 3% of the purchase price.
Okay. Because I know that's a big question that people always, they don't know all of the different things that go into those closing costs and why they have to bring closing costs. Like everybody need to get paid, basically.
Right. Right. Yes.
Next question. So when you are preparing to purchase a home, you know, a lot of people, they go and they tackle debt. And I usually recommend they speak to you first before they tackle debt, just because you can give them more of a strategic debt plan as to what things are going to really affect their score to improve their chances of the loan. You know, they may spend all this money paying this down where they should have paid down this car, which was really one of the big factors. You know what I mean?
Absolutely.
So can you talk about that? Like, what are some of the things that might be important to pay off to help them better qualify for a loan product?
Absolutely. And that's a great question. I'm glad you brought that up, because a lot of people may have a lot of credit card, maybe like JCPenney, Victoria's Secret, Capital One, or whatever. And the payment is like $25 a month. $25 a month is not a whole lot when it affects your debt ratio, where the balances might be a little higher. So you go and pay off of JCPenney where you owe like $2,000 or $3,000, and we only eliminated a $25 payment, which really didn't help your debt ratio for the most part. So I would, you know, once I review the credit, then I would say to you, okay, you have this installment debt for this furniture bill. And that installment debt, the monthly payment is $325, but you only owe like $1,000. Then I'm going to advise you to pay that off so I can eliminate that $325 payment. The other thing is we're going to look at your car payment. If you owe $15,000 on the car and the payment is like $300 or $400 or $500 or $600, if your car payment, if you can get that car payment down to less than 10 payments, then I don't have to count that car payment against you. And so I would take a look at that, and I would talk to you in reference to, you know, trying to get that down if there's a possibility. If you got much more than 10 payments on there, then we won't address that. Then we'll look at some of the other debt that has a larger payment, but doesn't have as much of a balance to pay off. So we'll kind of look at that. And then you might have 3 or 4 or 5 small things that maybe the monthly payment comes up to $100. And then, you know, like I said, I'll do the math to take a look and see how it affects your debt ratio before you use all your funds up to pay that off. And it really won't help your debt ratio. You might need to put a little bit more money down on the home or something like that. But yeah, those are the things that I would definitely sit down and advise you on.
So those some nuggets right there. That's some serious nuggets right there, because did you hear what she just said? If your monthly payment for the card is only $25, then that's not a good use of your debt pay down. If you have another bill that has a huge $300, $400 payment, you rather take that $2,000 and put it towards that payment that's $325, because that's going to take a bigger chunk. Well, basically that has a bigger claim on your paycheck. The $25 is not as big as a claim on your paycheck. So you're not really going to do any damage with that, as opposed to, like she said, if you bring that car note within 10 payments, then that can give you a better chance, which means you'll afford a bigger house because your debt to income ratio has lowered, and it gives you more wiggle room, which helps you be comfortable in the home, which is ultimately the goal, because you want to stay in the home and you don't want to be at risk of foreclosure. So these are some really good tips and information. So definitely, if you need to, get a pen and paper, watch the replay. If you do watch the replay or you're watching this, make sure you drop replay down in the chat and let us know. If you have any questions, definitely type them down in the chat as well. And then I'll go to the next question. You already answered the one with the DTI ratio. You answered that one automatically in what you said at the beginning. Okay, student loans. Handling student loans for, like, will they hinder you or slow the process? What if your student loan is in default?
Woo, you don't want that to happen. So if your student loan is in default, so here's what happens, is that especially if you're getting a FHA loan or it's backed up by the government, then we check what they call, and we don't check ourselves, the underwriter checks CAVers. And that's something backed up by the government. So if you have student loan issues, child support, back taxes or whatever, all that's in your CAVers. And sometimes we may not even know. So now when I see your credit report, and if I see that you kind of being in default in student loans, then I'll give you an 800 number that I've been able to get a hold to. And I'll have you to go and check your CAVers to see if your CAVers are clear. If you're in default, you then definitely want to go and pay that, pull that out of default. And you've got to be 3 months out of default before we're able to originate a loan for you with student loans. So let me say that one more time. If you are in default with your student loans, you've got to be out of default and have paid 3 months payment on time as agreed in order to come directly out of default and for us to qualify you to buy a home.
Good stuff. Good stuff. Okay.
The other thing with student loans, if the student loan payment is not on your credit report, and even though you have them in forbearance or whatever, we have to calculate 1% of the balance of the loan. So if your student loans is $96,000 total, I have to calculate 1%, which is $960. So one of the workarounds that I've been able to do, and for the last month or so, it hasn't worked as well because they completely, I don't know if student loan people are just not working right now or what's the situation, but in the past, if you're able to get a letter from your servicer that states that there's an agreed payment in a smaller amount than what the amount of the 1% is, it's an aggregated payment for the life of the loan, then I can use that payment. So the letter from the servicer has to state that this is a fixed aggregated payment for the life of the loan. In order to get that payment in that document, you would have to come out of forbearance and you'll have to agree to make that minimum payment in order to qualify for a lower payment. Otherwise, I need to use 1% of the loan amount or what's on the credit report.
Okay, that's a nugget too. Taking notes. Okay, what we got here? Does every lender require 25% down for an investment property? If not, how can you find lenders that allow a lower amount prior to having their credit ran?
Yes, so every lender does not require 25% down. I work with over 40 different lenders, and most of my lenders require 20% down. But if you get into investment property and if you get into commercial or mixed use, then you may require a larger down payment. But for the most part, you can get into a property with 20% down.
Gotcha. You already talked about the length of the employer. Do you know, like, does most lenders require reserves if you already have a rental property?
So if you already have a rental property, then you buy an investment property, and yes, they will require reserves. They're going to require, depends on how many rental properties you have. You might have to have 1 or 2 months reserve for each rental property that you have, and even for the new one that you're buying. So if you're buying, if you own 2 rental properties and you're buying another investment property, they're going to want enough reserve. They're going to want 2 months reserve on both 2 properties. So a total of 4 months reserve right there, and then maybe 2 months reserve on your new property. So 6 months reserve.
Gotcha. Okay. Best way to handle collections when applying for a home?
So the best way to handle collection will determine on what type of a collection it is. Medical collections, if you're buying FHA, you don't have to address those collections. Just write a letter of explanation. You were sick during a period of time. You had insurance. The insurance company should have taken care of it, whatever. So most of those you don't have to handle. So if the collection is more than six months old or 12 months, depending on the size of it, if it's less than $2,000, you don't have to address it. Because a lot of people, there's a collection maybe with $371 or whatever. I wouldn't advise you to go and pay that off because, one, what you're going to do is you're going to reactivate that account and it's going to show negative. And the $371 really is not going to make a difference in terms of your debt ratio or help the score. But if it's a large amount, like a huge charge off or something, and it's recurrent, then I will advise you to pay it off. But I'm able to write loans with people who have charge off and it's been over a year old and we overlook the charge off, or if it's really large, then we might calculate 5% of the balance and use that against your debt ratio. So it just depends. It's case by case on the type of charge off and collection it is. But for the most part, I would advise you not to. I would just advise you to give me a strong letter of explanation.
Okay. And then self-employed, like if you're self-employed and applying for a home, are there different documents that you may be required other than someone who may have W-2 income?
That's correct. Absolutely. So self-employed, and I'm writing a couple of loans right now for people who are self-employed. So it depends on your credit score, the type of property and all of that. So here's an example. I've got a gentleman who's buying a home and he's self-employed, and I'm using what we call a home prospector. So doing that, I'm only looking at his tax return. So I look at his tax return, and I'm only required to look at 1 year tax return to calculate the income. And so, but he also has to be self-employed for more than 3 years. So if he's self-employed for 3 to 5 years, then I'm only required to look at 1 year of tax returns. And then we have to have a profit and loss, a quarterly profit and loss from his CPA, and then a copy of his business license if he has one. If he doesn't, then I have to have a letter from the CPA that verify that yes, he has been self-employed for X amount of years. Some of the other, if you're self-employed and you haven't been self-employed that long, then I will need to look at your tax returns for the last 2 years. And I'll calculate that, and we consider that full, Doc. I calculate your net income, not your gross, your net income. And I take that and I divide it by 24 months, and that's what I use for income. Now, but these programs also, we can do this with FHA. You can get in with 3.5% down if you qualify. If not, then you can use what we call non-QM. And these loans are not backed up by Fannie Mae or Freddie Mac. You're required to put more money down, but we can kind of go stated or look at your bank statements only. So most self-employed people either go stated or bank statement, because most of the time they write off everything on their taxes, and there's not enough money on the taxes to help them qualify for a home.
Mm-hmm. That's what a lot of people experience. Okay. So this is actually a good question for you because, as you said, you deal with multiple lenders. So this question says, are local banks better than big name banks when it comes to getting mortgages, like for under 100,000?
Yes, they are. Local banks are better because one, it's the size of a loan. You don't want to, and then because with us, it'll be considered high cost because all the fees are involved, underwriter fees, the processing fees, and all of that. When you go to a local bank, they don't have to charge all those fees, and so they can originate a loan for you for 10,000 or whatever. We have a cap of about 75 to 80,000, but we only have a certain lenders that will do it because of the high cost. So in a case like that, your local bank is the best way to go.
Okay. And then, so if somebody's wondering if they should take a loan from their 401k to pay off credit card debt while they're trying to prepare for home, to buy a home, is that a smart decision? How would that be looked at from the loan side when looking at their finances?
So when you're buying a home and you want to exhaust your funds from the 401k, or you want to use some of your funds, most of the time you want to use your funds from your 401k to help pay your down payment. If you're withdrawing money, because you're required to have a loan estimate from myself and a copy of a contract, a purchase contract to do that. If you do so, I would pretty much pull the money out, to pay for the down payment. But if you need to pay something off before closing, then you want to pull enough money out, to pay the down payment and to have enough money to pay whatever that debt is off. So the down payment could be like $5,000, and you have a debt that you want to pay. That's another $5,000. Then you want to pull at least $10,000 off, and then you would just say, okay, I would like to eliminate that debt at closing, if that's on your credit report. So you have your down payment and enough money to pay that debt off at closing. So yeah, I would do that all at the same time. I wouldn't necessarily just pull that out to just pay off the debt. I mean, because you're going to have that loan out there, and then we have to calculate that loan against you. So if you're going to have a loan out, because we're going to require the terms and conditions anyway, you might as well pull it all at the same time, especially if you know you're going to buy.
Okay. You already answered that. You don't have to have zero credit card debt. So, I feel like you've answered them. Right, you've answered the questions that I had. I just dropped in the comments if anybody has any additional questions. Also, too, you mentioned that you work with multiple lenders. For this reason, like sometimes when you go and you work, you have loan officers and you have like mortgage brokers who you work with multiple lenders at the same time, which gives you an opportunity to work with and see what different banks or lenders will be able to offer you. So that's a very beneficial, I guess you could say, tool to have when you are looking, because remember, you're not glued to any lender. Like you don't have to get the loan. You don't have to get a loan with this specific person, and you might find somebody who can give you better terms that are more beneficial to you. Sometimes the first person might not give you, the best thing for you or the best opportunity, the best loan product. That's the best way to say it. So dealing with a broker is very beneficial to you. I just wanted to add that.
Yeah, let me piggyback on that as well, because I've been in the business for a long time, and I have worked for banks before. And the banks, for me, I felt like it limited my clientele, the market that I serve in, because they were very conservative, and they weren't lenient enough. And then when I started working for brokers, there's so many brokers that got, because they have so many private investors or whatever, that has so many programs and products. And like you said, I won't call any bank's name or whatever, but I mean, when I worked at banks, I couldn't do this loan there. You don't have a 640, you don't have a 660, I couldn't do that there. Or you're in bankruptcy, I couldn't do that there or whatever. But working with a broker, and I don't work with all 46 lenders, and I'm huge on building relationships or whatever. I have a handful of lenders that I work primarily with because I built a relationship with them, because I know what my market is and what tail is. So I have a lender for a 580 credit score. I have a lender for a 700 credit score. I have a lender for a 203K rehab loan. So I have my niche are from my clientele. So if you came to me and you have a situation where you have a bankruptcy or you just got out of foreclosure and whatever, I have that particular lender who I can just call anytime, almost any day or night. Hey, so-and-so, hey, I've got this client and this is the credit score we're dealing with. They just got out of bankruptcy or the foreclosure happened, blah, blah, blah. And the credit score is blah, blah, blah. And what's your debt ratio? What's the turn time right now? What's the requirement? Are there any new guidelines that I need to be aware of? And they say, oh, Arlene, we could do that and blah, blah, blah. And that's the reason I work with brokers, because I've been very successful in having to assist my clients in getting into home, because we all have unique situations. We all had some things that have happened to us in the past, and our credit might not be the best and squeaky clean. Because if you got really good credit and squeaky clean or whatever, you can go to any local bank and get a mortgage. But if you got any type of little blurs or any kind of concerns or just a hiccup, maybe you didn't have a job for 2 years straight, but you had a gap in there. Those are the types of situations where when you come to brokers like myself, that we're able to assist you because we know how to guide you and we know what lender will help you in that situation.
Okay, that's good information. That's good information. And it's very true, because you have so many different things going on. And, me being a financial educator, a lot of us don't receive personal finance education. So we find out by messing it up. I know that's how I found out. I wasn't always a good steward over my money. I used to mismanage my finances pretty badly, but I learned and I do better now. But like you say, so I would have hiccups in the past, or things weren't good or things. So it's important to know that you still have options. And just because you have those hiccups, that does not mean that you are barred from home ownership and you're not able to own. You have you have resources and loans and lenders who are still out there that will work with you. So don't let that discourage you and think that you don't have the opportunity to be a homeowner. You do. You just have to find lenders that work for you. That's the broker's clutch. Like you say, you got one lender. This is your 203K loan. That to me is good information also, because that's very true. You have some lenders, this might be their niche, and this one, that might be their niche. So I think that's real good info also.
Awesome. Great. Really good.
Yes, nobody dropped any additional questions. I dropped all the questions that they originally asked before. You have been so helpful and informative. Please let them know who you are, where you are, how they can contact you. If you like, I can add you in a group as well. She's located here in Illinois, just FYI. Do you service any other states?
In Indiana, and I'm working on my license now for Florida.
Oh, I'm moving to Florida. Okay, all right.
Yeah.
Good to know.
Yeah. So fantastic. Yeah. So Arlene Price, and I'm with Team USA Mortgage, and I can be reached at 630-439-4497, and I'm text friendly. You can email me at arlene.price, PRYCE, Yes, and I would love to be in you all's group and just kind of follow up. And feel free to call or text or email me with any questions or concern, any scenarios. It's Arlene.Price, Pryce, @gmail.com. And, let you guys know, I grew up on the west side of Chicago, and, and I wasn't educated on finances and, and building wealth and building a legacy. And so, since I've gotten this knowledge and been, God has blessed me. I always pray, bless me so I can be a blessing to others. And I just want to be able to go out and educate others and, just kind of guide you and help you with finances and you too and own a home and build a legacy and leave something for your family and your children and your children's children. And that's one of the things that we got to on. And you know what? And it's easier to buy a home than it is to buy a car, believe it or not. People think it's difficult. It is not that difficult at all. Once you get started, you'll be like, oh, wow, you didn't think you could buy? You can, because if you're paying rent, you're paying someone's mortgage. You're just not paying your own. So we want to encourage you to pay your own.
That's very true. If you're paying rent, you're paying somebody's mortgage. It may not be yours, but somebody's mortgage getting paid.
Absolutely.
Or somebody, you done paid off somebody's mortgage and they just collected it.
Let me tell you a little story about that. So I finally calculated when I was renting on how long I had rented from this person and how much mortgage I paid. And I was like, I didn't even realize I could even save that much money. I mean, it was thousands of dollars, not $20,000, like $60,000 or $70,000. Yeah. And that's an eye opener.
Wow, that's enough to buy a house outright.
Exactly.
My investment property wasn't even $60,000.
Exactly. So when you
two of them.
And so that's what I do. I tell people to calculate how much you're paying for rent, multiply it by 12 for the year, and then multiply by the number of years you live there. And then see once you be encouraged to go buy a home.
Okay. I mean, and it's also leverage too, because it's also something for you to teach your children. I always tell people, if you're going through this process and you're learning, then make sure that you are teaching your children and make sure you are making them a part of the process, especially if they're older and they're teenagers. I know they might not be as enthusiastic about being a part of it, but as they get older and they get into life, I have a 20-year-old, they are so appreciative because none of their friends know. And they're like, Mom, I mean, she's like, Mom, like, oh my God, like, oh, I'm so glad, like, because she's the reason why she got an apartment, because her credit was a 750. And she didn't understand, why I was constantly drilling in her, what's your best friend and your best enemy? I always tell her, what's your best friend and your worst enemy? And she finally learned compound interest. That's what I tell her. What can be your best friend, but your worst enemy? And she's compound interest. And that's what we used to do. That was our morning conversations. We would talk about IRAs and things like that. And she didn't appreciate it then because she wasn't interested in it. But now that she's out and she has her own apartment and she's getting out there and she's learning how to manage her finances on her own, she appreciates it now. So they may not listen to you then, but when they start in that real life start hitting them and they start seeing the value in it, it'll change their outlook on things. Definitely.
Yeah. Good stuff.
Well, we truly appreciate you for coming in. I'll definitely invite you in the group, and I will make sure I make a post with all of your information because I have your email and your phone number. So I will post that information to let them know that you were the loan officer who spoke at the March training for anybody who's interested in your info. And again, she's in Indiana, soon to be Florida, and Illinois. So I hope you have a fabulous evening. Thank you so much. You dropped gems. She came in here and just spilled tea all over the table.
Well, thank you for having me. I really appreciate it. It was a pleasure.
No problem. You all have a wonderful evening. That concludes our March training. Bye. Until next time.
All righty. Talk to you soon.
All right.